So without further ado, we'll go on to something a bit more positive, and again, something maybe perhaps something more biased on is the Holy Grail, the single let, and let's get straight into the effort on the single lets. So I've put a 1 for single lets. Okay, yeah, you've got your refurb. It's typically less in depth than a flip. It's normally just cosmetics. You might do something structural to add a bit of value, but ultimately, if you overspend on a single let, not that you want to, you should budget and try and hit that budget. But if you do, you're looking at, okay, that's just going to take me another year to pay that off. It's not, well, I've wasted so much time, I've been stressed, I've been snappy with the family and all sorts. It's just, okay, it's a long-term investment, it's just going to take another year, but I'm in it for 20 years anyway, so hey ho, lesson learned, on to the next one. Capital required, I put a 2 again. That's because you do need some cash. Again, you'll need your 25% deposit typically, and your refurb cost, but often it's a lot less than if you're doing a flip. And then experience, I put a big fat 1. That's because this is where I try and steer anyone to start out. It's not going to sell any courses, and that's probably why most people that come to me that haven't even bought their own property are like HMOs, rent to rent, SA. Okay, fair enough, they might have the financials to go into a single let, but typically when you're looking at something like a net profit per month of, especially in our area in investments, we look at £200, £250 a month. It's not exciting, it doesn't sound exciting, but I'll touch on it in the positives, that when you start getting a few of these under your belt, it does sound a lot more appealing. So to put it in some context, and again, like I say, some of these might sound more biased than others, but we are currently focusing on our single let purchasing strategy. That's because we've got the funds in place to fund them. They seem like compared to some other strategies, they're easier to source, they're easier to churn out, and also it's a business that's quite something that you can replicate and is easier to scale, which I think is quite valuable. I've learnt myself this year that having momentum is probably a bit more valuable than getting the best possible price. I'd rather buy 5 properties at £2,000 more per property than buy 1 property and make that £10,000 saving, because over the long term those 5 properties are going to perform a lot better than that 1 property. So yeah, put it into context, we're currently purchasing a property that's going to achieve a ROAS around, well, this one's actually achieving around 30 to 35%, but typically we'll look at a criteria of 25% ROAS plus. So that's your return on capital employed. So what that's saying is, by the time you've invested in this property, added some value, refinanced, the cash you've got left in that versus what your net revenue is, what your return investment is based on those 2 figures. We will do some videos on those, so I've just skimmed across it and might have said something wrong then, but yeah, that's essentially a metric that we look at when we're looking at single lets. So some of the positives that I've already touched on is it's a straightforward process that you can do, and I say it requires no experience. That doesn't mean you can't go wrong. You can definitely go wrong. You're not likely to go as wrong though, and you're going to have to start somewhere, and that's where I think you want to be starting. So it's a great learning ground for if you have any slight mishaps, and like I say, it's just going to be adding another year onto your payback time essentially. It's cost effective as well, something that people that start out in property will not realise. The next topic I'll be going on to is commercial investment. Residential single lets, you can go to the bank, get your 75% loan to value, mortgage, easy as that. Quite often the broker will do it for free if you've got a good relationship with them. The valuation process can sometimes be free as well. There's no set-up fees with the lenders. You can get competitive interest rates. It's a totally different story when you go into bigger projects and you get branded as commercial, which, by the way, a lot of HMO mortgages will be branded as commercial. Tenants are typically, obviously, tenants are tenants. All of these strategies involve people and tenants who are notoriously unpredictable and unreliable. But the tenants in single lets, especially the ones I've So the two first investments that I made were both single lets in a very working class area of Stoke. I've had those now for 5+ years. One of them's had the same tenant in since day one, and it probably averages one maintenance call out a year, varying between 45 to maybe 200 quid, because like the lead flashing came off the chimney, or that's a kind of 200 quid one, to a leaking tap, 40 quid. But one of those properties has had the tenant in since day one, and they've paid the rent on time every time. The other one has had one tenant turnover, relet it, didn't have to do any work on it, relet it within a week. So, happy days. So some of the negatives to single lets is, again, like I touched on earlier, is they might not seem very appealing to people. Anyway, the ones we're looking at, anywhere between £200 per month to £275 profit per month, does not sound very exciting. But when you're considering that you're only leaving £7,000 in these, people that are going into property investing will say with £100,000 in the bank, if you're leveraging that money and recycling the cash and only leaving anywhere between £7,000 to £20,000 in per property, that £200,000, that £250 per month can add up to a significant figure. And it's like anything with an economy of scale. Once you've got a few under your belt and you've got that revenue in, the profit margins, I don't know why, just seem to settle out and become a lot better. Because the other negative I'm going to touch on is maintenance. The maintenance is relatively low, but if you do have something, i.e. you didn't replace the boiler when you refurbished the property, if something like a boiler goes and you're looking at a £1,500 to £2,500 replacement, say, depends where you are in the country, that's going to wipe out a year's worth of rent. And if you've only got the one property, it is going to feel like a kick in the teeth. But if you manage to gather some kind of momentum and you've got 10 under your belt making £2,000 a month, and yeah, okay, it's wiping out a month's worth of revenue, and let's just hope that all 10 of them don't happen within the same year, and you just seem to find that there's an economy of scale, and the law of averages means that it becomes a lot easier, a pill that's much easier to swallow when these unexpected things do happen.